Hello, it was nice meeting everyone. This is Professor Zan. In last class, we talked about balance sheet, right? Balance sheet is a company's financial position at one point of time. It's just a quick snapshot of a company's financial position. So it it has the we use the basic accounting equation to represent company's balance sheet. So it started out with asset. Asset is everything you own of the company. Everything you own owned by this company equals to liability. Anything you owe to your creditor, the company owes to the creditor, plus anything the shareholder has the claim to it. So the shareholders claim, we call shareholders equity, that's equals common stock plus the retained earning. We also talked about in last class, when you started your own business, you need to have a CPA or yourself to register an entity for you to operate in your business. So it could be corporation, it could be partnership, or it could be sole proprietorship. So now you have operation, you have an entity, so you could start operating your business. When you start operating your business, you will have all of these different operating activities, right? So the operating activity could be started out like, say, you buying goods and a service from outside suppliers. So by buying a goods and service from outside suppliers, you give your suppliers a promise to pay. And then when time comes, you have to pay the cash to your suppliers, right? So it's accounts payable, then you have to pay the cash to your suppliers. Once you bought all of these goods and service from your customers, and then you can start selling your own product. So you made your product, you have your service ready, and you go out, you sell your own product and service to your customers. Once you sell your product or service to your customer, you receive the right to collect the money from your customer, from your outsider service that you provided to, who you provided to. And then few days later, when a time comes, your business can receive the money from your customer, right? You give up the right to collect the $50 after you receive the money. So this is called operating cycles. This operating cycle is almost same for almost every company. The only difference is that each steps that is involved, the length of each steps could be different. Some companies, pay their suppliers at the spot when you buy the goods or service from suppliers. Some company don't pay them until 30 days later. Some companies don't pay them until 60 days later. Some companies collect the cash from, like retail services, you collect the cash from customer right at the spot. Some companies don't get the cash from customer until 60 days or 70 days, but the operating cycle is always the same. So now, as you are starting operating your business, you have all of these operating activity going through. You kind of have, calculated in your own head, saying like how much money you should be able to making, right? But that's not always a good idea. You want to have everything either before you start operating it. You want to have a projections, right? Because you're going to set up the price you want to sell for your product, you want to set up the price for the service you provided, and then you estimated the cost of doing all of these business. So making sure that at end of the day you can make a profit, making money. And this summary of all of these activity together to to determine whether if you are making a profit or not is called income statement. So income statements also refers as the statement of net income or loss. So income statements, same as company, as we see here, you started out by company's name, Sonic Gateway, and this income statement is a projection, so it's a projected income statements, and then give the time period. Time as period assumption is very important for income statements. So if you remember, I said for balance sheet, it's the snapshot of one point of time, just for the normally for the balance sheet, it always says as of September 30th, 2015. It's just at that one point of time. So for income statement, you could do the whole 1 year worth of income statement. You could also do it 1 quarter income statements. You can do it a 1 month. You can even do it a weekly if it makes sense, right? So you have to make the time assumption here. So this one is just for 1 month. So that's why it's for the months ended September 30th. So the beginning portion of your income statement is your revenue. And revenue is that money you are earned or money that you charge to your customer for the goods you're selling to them, or the service you provided, the amount of money you charge for the service. That's your revenue, right? Total revenue for the month. And expense is cost of doing all of these sales or providing service for the month of September, the cost of doing that. So that cost include cost of salary and wages for your employees who provide the service, who selling the product. And that cost also include the rent expense they rent for the office. The cost include utility expense that you incurred for the month of September while you are operating your business. The cost also include insurance expense. So on and on. A lot of it's just expense basically is the cost of you doing business. And the difference between the revenue and expense we call it's either net income if it's positive number, or it could be net loss if it's the loss if it's negative number. So if you recall again, net income is a part of owner's equity, right? So the retained earning, owner's equity include common stocks and retained earning. And retained earning is the beginning of the retained earning plus any net income that you are making for the year for the period and minus any distribution you've made. So whatever you have the balance, it's called the retained earning ending balance, which should be part of your balance sheet. So in other words, if you still remember, liability plus equity is on the right hand side of a basic equation. So when you have a net income, you should see an increase in your owner's equity. Okay, we're talking about this time assumption. So there's two accounting ways to record your revenue and expense. One is a cash-based accounting. So as that name states, cash-based accounting basically means you record the revenue when cash is received, and you recognize your expense when the cash is paid. So the receipt of cash or the disbursement of the cash dictates the recognition of revenue and expense. That could be a problem, right? Why is this a problem? Think about it. You don't always receive cash when you sold your product or you provide your service. If you sell your product on account, which means you don't receive the cash until 30 days or 60 days, whichever the time period you give it to your customer, then you can record your revenue. So say that you sell a product and the customer don't pay you until 60 days later. So between now and the 60 days, you don't have a revenue according to the cash-based accounting. So there's a big time lag here. From the expense side of it, it's the same thing, right? When you provide a service to your customer, when you sell this product, you have an employee there, employee who's, or you incur the utility expense, right? Rent expense, but you don't necessarily pay when the expense incurred. You probably don't pay until a few months later. You probably also prepay the expense. A lot of time you prepay the rent expense. If you record expense when the cash is paid, and there could be a big problem because the timing and the mismatching between the revenue and expense. So that's why cash base is not allowed under the GAAP or the International Financial Accounting Standard. So under GAAP or IFRS, you are required, all the companies are required using accrual-based accounting for external reporting purposes. You may use the cash accounting for your own purpose, but you can't use it for the external reporting purposes. And for the external reporting purpose, you have to use accrual-based accounting. So, what is accrual-based accounting? Accrual-based accounting basically means you record your revenues when they are earned, and you record your expenses in the time period as a revenue to which they relate. In other words, the cost of doing the business should be recorded at the time when you are making your revenues. So the timing of the cash receipts or payments does not dictate when you should record your revenue or expenses. Let's go through some case examples. Revenue recognition principle according to GAAP. Revenues are recognized when they are earned. So which means the earning process is finished. Okay. So case number 1, you receive your cash before sales or service. Give you an example, right? The example here says you as a company sell a gift card. So one customer comes into your company, bought $50 of gift card. This is just gift card. They didn't buy the product, they didn't buy the service. They just bought a $50 of gift card. They already give you the money of $50. So the company already received the money, which means your cash, if we are analyzing the transaction and their effects to the basic accounting equation, you know when you're receiving the cash, your asset increase. But is there revenue at this point of time? You're not providing your service. You have not sold your product. All you did was you giving your customer a promise that by getting the $50, I'm giving you gift card. I promise I will give you $50 of product or service whenever the times come. So there's no revenue, but I do have obligation of this promise to give you $50 worth of product or $50 worth of service. So that promise is not a revenue, it's a liability. It's called unearned revenue. Unearned revenue in your basic accounting equation is part of the liability. So in that case, your liability is increased, your asset increased, but no revenue at this point of time. So, and then few days later, your customer walking in your store, give you $50 of gift card, bought a $50 worth of product. So you no longer have this, your promise already fulfilled. You no longer have this obligation to your customer. So your liability decreased. Your unearned liability is decreased. It's gone. You no longer have this unearned. Your unearned revenue just became revenue. So you can record your revenue now because your earning process is finished. You already sold your product. You already provided your service to your customer. Case number 2, cash receives with the sales and service. So the customer walking into your store bought a $50 worth of product and give you cash. So that's when what? You receive the cash from your customer, so your asset increased. And you also gave the product. You sold your product to your customer. So your revenue, you already had a revenue. You should record your revenue because your earning process is already finished. So you should record your revenue. Let's look at case number 3. So case number 3, service or sales before and cash after. What does this mean? So it means a customer comes into your store and they give you a credit card and they bought a $50 worth of goods from you. So you get credit cards, but you don't actually get cash, right? You get cash from a credit card company 30 days later. So that 30 days later, the credit card you are getting, you signing, the customer signs their names and their receipts, which means they give you company a right to receive $50 from the credit card company. So your service and your goods, you already sold the goods, you already provided service. So at that point in time, the earning process is already finished. So you cash increased, your accounts receivable increased, not cash, because you haven't received the cash yet. But you have the right now, so your accounts receivable, which is also part of your asset, increased, and your revenue also increased because even though you haven't got the real cash yet, but you already provided your service, you already sold your product, so you can record your revenue. And 30 days later, you receive the cash, real cash from the credit card company. So at that point of time, your asset increased because you receive your cash. Your asset also decreased because your accounts receivable decreased. But there's no revenue because you already record the revenue when you sold the product, when you perform the service. So the second stage is when you receive the cash. You just reverse. You taking down your accounts receivable, you increase your cash, but there's no revenue. You already recorded. Okay. So expense recognition principle. This is in the gap what we call matching principle, because you match your expense to the revenue at the same period of time. So in other words, record expense in the same period as the revenue with which they can be reasonably associated with. So let's go through three cases again. So you pay, it's this first case number one, it's cash before expense. You pay a cash and you go out to a store, you bought some supplies for your company. The supplies you bought, a stack of papers, envelopes. So you bought it and you put it in your cabinet. You haven't used them. So is there expense? No, you haven't expensed those papers yet. So you bought all of these things as suppliers, put it into your company's cabinet. You call those things as asset because it's at your perception, it's yours, it's an asset. Your asset increased. What else? What's decreased? Yeah, it has to remember the double entries has to be one or and should be another entry. So your cash also decreased because you already paid the cash for your supplier. So you have asset increase because supply account is increased, and your asset decrease because your cash decreased. But did you have expense at this time? No, you don't have expense because you haven't used your paper, you haven't used your envelope yet. So at this point of time, there's no expense. A month later, all of your papers used up, all of your envelope used up. So all of these supplies already expensed. Now you should record your expense. So when you record expense, you should also taking down the supplies account. So the supplies account in your asset should be decreased because they're no longer there. They already used up. They're already part of the expense. In other words, you expensed it. So you should record your expense. So in this month, while you're making sales, while you're providing service, you also use these papers while you're making products, while you're making services. And case number two, cash with expense. Cash with expense means you pay cash when your electricity used up. As you use electricity, you have to pay your cash. So this is a cash with expense. So once you expense it, you also pay the cash right away. So, and here there's a two double effect. Again, your expense increase because you already use the electricity. Your cash decrease because you pay the cash. So now expense is reported. And the case number three, the expense before and cash after. See, you pay these advertising service, right? It's online advertising. So they do online advertising for a month and they didn't charge you. They just give you maybe an invoice, right? For the last month's online advertising service. So expense is already incurred, right? These already happened. The advertising service already used up. It's already happened. So you record expense. It's called advertising service expense. But you have not paid out your cash, but you owe to your supplier, you owe to your vendor. So you have a liability, you have accounts payable. Your accounts payable is part of your liability increased because you owe to your vendors, so you owe to your suppliers. And 30 days later, right, you paid it to your cash, you paid it to your vendor. At this time, there's no more expense because you already record expense, but your cash will go out of the door. So which means your asset will decrease because your cash decrease. And your liability account, your accounts payable account, also decrease because you already paid the cash and you no longer have the obligation to pay. Okay. So now let's go through this. These are just activities, transactions that happens, right? Let's now analyzing some of the transactions. Okay. First of all, we have to go through this basic accounting equation again. Your accounting equation is asset in the left equals liability plus stockholders' equity, right? Liability and stockholders' equity is on your right hand side. Remember, everything on your left is debit, credit is right. So everything on the right has a credit balance, everything on the left has a debit balance. Okay, so this is the T account. And then under the shareholders' equity, you also have common stocks and retained earnings, right? Common stocks are also part of equity. So increase in common stocks is the right hand side of it, so it's a credit. Retained earning is also at right hand side of it, increase, so it's credit. And under the retained earning, you should have net income. And net income, you have increase in your revenue, is also increase to your retained earning. So increase to your revenue on the right hand side is credit balance. And increase to your expense, which is deduction to your retained earning. So it should be on your left hand side, then it's a debit. Okay, let's go through these transactions. So transaction A. Sonic Gateways now sell games for cash. In September, Sonic Gateway sold $3,000 worth of games at its online store, and you sold it with cash, for cash, right? So you receive Sonic Gateway, receive the cash right away, and you sold the $3,000 of the game, give it to your customer right away. So can you record revenue? You see the word sold. So which means the earning process is already finished. You sold your product. So you can record your revenue. You record your revenue. Revenue increased, right? What else is increased? The cash account is also increased because you sold it for cash. You have $3,000 of cash just coming into the company. So in your basic accounting equation, there's two effects. One effect is increase to your asset. Another effect is increase to your equity because you increase your retained earning, you increase your revenue, you increase your retained earning, you increase your equities. So the accounting journal entry would be, because it's a debit to asset, so it's a debit to cash. And it's also a increase to the equity, so it should be credit to your sales revenue. And if you want to put it into the T-trial account, this is how T-trial account looks like it. Transaction B, you receive cash for future service. As we illustrated before, now you issued three $100 gift cards at the beginning of September. So you just receive the cash of three $100 gift card from your customer. You receive cash from your customer, and what you give it to your customer is just $100 gift cards, three different $100 gift card. You did not sell the product, nor did you perform any service. You just give your customer a promise saying that you can come back with these gift cards and I will give you $100 worth of product or I will provide you $100 worth of service. So you give your customer a process, right? So what can you record now? You receive the cash. Yes, you have increase in your cash. So what else is increase? Remember, we said you just issued or you issued a gift card. The earning process, you did not sell product yet. You did not perform any service yet. So at this point of time, all you have is your promise to your customer or your obligation to your customer. So in other words, you have a liability that owe it to your customer. Remember, the liability, what we call this liability is unearned revenue. So if you look at your basic accounting equation impact, you could see that cash increased because you already received $300 for $300 worth of gift card. And then in your liability account, there's an account name called unearned revenue. Basically, it means your obligation to give the product or service to your customer, $300. Okay. Unearned revenue, remember, it's not the revenue yet, has no impact to your income statements. It's your liability, and it's in your only impact to your balance sheet in your liability section. So the accounting journal entry looks like you debit cash, which is in your left hand side of it. You also credit your unearned revenue because it's your liability and it's on your right hand side of it. So you credit unearned revenue. And this is a T account looks like it. Transaction C, you sell a app on credits. So Sonic Gateway sold $9,000 of app in the App Store or on Google Play. Remember the keywords here. You sold. You already sold $9,000. You sold it on credit, which means you did not receive any cash, but you already sold the app. What does this mean per GAAP revenue recognition principle? Because you're earning already, you already earned, the earning process is already finished, you sold it. So now you should be able to recognize the revenue, right? Not only recognize your revenue, you also have, because it's on credit, which means you have a right to collect $9,000 from your customer. You did not receive cash yet, but you have the right to collect. And that right to collect is called accounts receivable. So accounts receivable is part of your asset. So you have increase in your accounts receivable. You also have an increase in your sales revenue. And sales revenue is part of your retained earning. Retained earning is part of your equity, which is in your right hand side of it. So here the journal entry looks like a debit in accounts receivable and credit to your sales revenue. This is how T-trial account looks like it. And then D, transaction D. Transaction D says you receive payment on account. So Sonic Gateway received cash totaling $8,500 from Apple and Google. Remember the transaction C, you sold $9,000 on credit, meaning you have credit on account from Apple, from Google. Now, 30 days later, Apple and Google gives you the cash because you have the right to collect $9,000 from them. Now they said we pay you $8,500. So you receive the cash, receive the check, which means your what? Your cash account is increased. And what is decrease? The accounts receivable. Because you had accounts receivable of $9,000, you already recorded. Now you already received the cash, so you have to reverse the accounts receivable. Is there revenue that you should record? No, you already recorded $9,000 revenue when you sold the app. So this earning process already finished. You already made record of it, so you don't record revenue anymore. So the accounting transaction looks like it. So you increase in your cash, called debit, in your cash balance and you decrease your accounts receivable. Decrease in your left hand side of it is credit, so you decrease your accounts receivable. And if you look at the T account, so accounts receivable now it's a decrease of $8,500. Transaction E. So at the end of months, as you are making all of these sales, providing your services, your employee has to get paid. So at the end of months, you wrote a check to your employee and totaling $7,800 for wage relate to the hours worked in September. So you paid money, paid cash to your customer, so your cash decreased. And your employee also get paid. Your employee's expense, employees' salary, wage are expense, right? They are expense, they're cost of you doing all of these business, making these sales, providing those service. So it's called employees' salary expense. So employee salary expense is decrease to your retained earning, decrease to your net income, decrease to your retained earning, also decrease to your equity account. So you have increase in your cash account, you have decrease to your equity. So the accounting journal entry looks like making debits to supplier wage expense and you credit to your cash because it's decreased to your cash account. And that's how the summary of T trial balance looks like it. So F, transaction F, you pay cash in advance. So September 1st, Sonic Gateway paid $7,200 in advance for September, October, November rent. In other words, you pay for the expense before the expense incurred because the September has not passed yet. November, October has not come yet, but you already prepay all of these rent. So in that case, you prepay your rent, so you have an account called prepaid rent. Prepaid rent is what? Is your asset account. So you have an asset account called prepaid rent because this is the rent that you paid. You can banking it, right? You're banking it yourself, right? You put your banking into the landlord account saying, I can use this money for my November, October's rent expense. I just put it money in there first. So these called prepaid rent. Prepaid rent is part of your asset. It's not expense because they have not incurred expense yet because you paid out cash, so your cash decreased. So now in your transaction, there should be a debit of prepaid rent because the prepaid rent is, again, asset account. A lot of students confused with this account. Prepaid is asset account. So it's a debit to your prepaid account. It's an increase to your prepaid account. And it's also decrease to your cash account. So it's credit to your cash account. Here's the trial balance looks like. Now, transaction G, it says incurred cost to be paid later. What does this mean? Sonic Gateway displayed Facebook sidebar ads in September and received a bill for $500 to be paid in October. In other words, you already used Facebook sidebar ads in September. You got a bill, but you don't have to pay until October. Right? The expense is already incurred because they already display in the face sidebar, they already displayed it. The advertising or whatever the expense you already used up, but you just don't have to pay it until October. So which means you have increase in your expense because you already incurred the expense. It's called advertising expense, whatever the expense account name, you named it in your chart of account. You also have what? You have a liability because you're not paying now. You are obligated to pay your vendor in October. So you have accounts payable in $500. So if you look at the basic equation here, you have a liability, which is accounts payable. You're paying to your customers or vendors for $500. And then you have advertising expense increase of $500. The increase of expense is decrease to your net income. In other words, decrease in the net income is a decrease to your equity. So in your equity section, you should have a negative expense. So if you look at the accounting transaction, remember anything decrease to the right hand side of the equation should be debit. Anything increase to the right side of the equation should be credit. So you have a debit of advertising expense, you have credit accounts payable, and that's the trial balance. Not trial balance, I'm sorry, it's a T account. So now here's the transaction H. You pay cash for expense. Sonic Gateway was notified by its bank. There's a automatic monthly payment of $600 was transmitted to its utility company for the electricity used in September. So by the end of September, and you got a notice in your bank, in your bank account saying we paid $600 to the utility company for the months of utility that you used, right? So you already used utility, already the months of utility in September already used up, which means you already incurred these expense. And then you also paid a cash for it. So now you have increase in your expense. Again, increase in your expense is decrease to equity because increase in your expense is deduction to your net income, deduction from your revenue, and then it's a negative to equity. And then also there's a negative of $600 because you have to pay bank. It's a deduction of your cash balance. So if you look at the transaction journal entry, it should be utility expense is increase. That's always the debit side of it, increase. And then you have a decrease in your cash. That's credit because it's decrease of balance in your right hand side of equation. Here's T account. Okay, so remember what we said in chapter 2, right? The accounting process worked, the systematic accounting process. You start out by analyzing it. You also then you record transaction, right? After you record all of transaction, then you run a summary, and that summary is called unadjusted trial balance. And that's the sample of unadjusted trial balance. So you have a cash balance. All of asset account should have a debit balance because it's in left hand side of it. And then all of your liability account should have a credit balance because it's all on your right hand side of it. And then the bottom portion is your income account. Your income account, you have a revenue because the revenue is increased to your equity account. That's why it's on your right hand side of it. That's why you have a credit balance. And then you have expense. All of the expense are deduction to your income, deduction to your retained earning, and deduction to your equity account. So they are having a debit balance. The both should always be equal. Okay, and here's the cash ledger account looks like it. So let's go through to do a kind of review of all the revenues. Remember, you can receive the cash before revenue is earned. When you receive the cash before the revenue is earned, what do? It could be the deposit for a service you need to you will provide in future, right? So you receive your cash first. So you have increase in your cash, which is debit to your cash, right? And you also have an increase to your unearned revenue. Unearned revenue is a liability account. So there's an increase to your liability, but there's no revenue yet. No revenue yet. Only when after a month, after you provided the service, then you kind of reverse the entry, reverse out the revenue entry, which means that you have to record, reverse. No, you have a credit balance of unearned revenue. Now you debit the unearned revenue, and then you record the revenue because that's when the revenue, the earning process is finished. And then you could record the cash at the same time as revenue is recognized. So that's when people walk into store, pay the cash, and you give them the product. The earning process finished at the time when you receive the cash. So you record you increase in your cash. You also recognize revenue. There should be increase in your revenue. And then in the third type, so you earn your revenue, you receive your cash after the revenue is earned. So when you provide a service, when you sold your product, you don't receive your cash. You receive a right to receive the cash. You sell your product on account. So which means you have accounts payable. And then also you can recognize your revenue because you already made sale. You already provided service. The earning process is finished. So you can record your revenue. But the cash, you can only record the cash after you receive your cash. So now you have increase in your cash, decrease in your accounts receivable because you no longer have the right. You already received the cash. Okay. So here, let's review the expense recognition, right? So when you receive the cash before the expense is incurred, so which means you prepay the rent, you prepay the insurance for a whole year, right? That rent has not really used up. You're banking it. When you're banking it, the account called prepaid expense account. The prepaid expense account, because you're banking it, it's part of your asset. So you have a debit to your prepaid account. And then you have credit to your cash because you already paid the cash. You pay the cash before the expense is happening. So then later, when after the month, right, you're used up your rent, the landlord can totally take away the money. They can use the money. So you already expensed it. The month's already passed it. So that means you can recognize your revenue. Your expenses already, sorry, you can you can recognize your expense because your expense is already incurred. And then you have to swap. You have to reverse out your prepaid account because you are using the banking money and for your expense. Second would be expense at the same time as you paying the cash. So that means the utilities, right? When you used up utility, you also pay the expense. So your expense incurred as at the time when you pay the cash. So that's when you record expense. You also decrease of your cash. Cash could paid after expenses incurred, right? For the advertising expense, you incur all of the advertising expense first, but you don't pay those vendors until 30 days later. So you have increase in your expense account because it's already incurred. And then you also have accounts payable. You have obligation to pay your vendor 30 days later. So after 30 days, you can reverse the account because you pay the cash and you no longer have the accounts payable account. So now you have all of these transactions, you run the trial balance, you put together a net income statements, right? So in your income statements, you want to say, like, look at your income statements. You want this bottom number to be positive, right? If it's positive, mean you're making money. If revenue minus your expenses, you have $2,000, $3,000 positive, which means you made $3,000 for the business, right? And so, but is $3,000 good enough, right? Is what if another company, right? They may have a much bigger in scales, and they made $5,000. But they invested a lot more money, but they made $5,000. You made $3,000. Does that mean they have a much better performance than you? Not really. It really depends how efficient you are making your money, right? You want those numbers to increase, the revenue number increase as quicker as you can. Especially you want your revenue increase in much faster than the way you are increase your expense. Because as you increase your revenue, your expense relatively always increase. But you want your revenue to increase much faster, right? So there's another way of measuring that, and that's called net profit margin. Net profit margin is net income divided by net revenue. So from that formula, you can just say, it's saying in that much of revenue that I'm making, how much of that is my profit? So let's look at this example. In this example, you have net income, right? Revenue minus expense. You have $3,100 of net income. And then you put it into that formula, net income divided by the total revenue. So it's 25.8%. What does this 25.8% mean? The profit margin mean? It means in $12,000 of the revenue you are making, 25.8% of it is my income. And this number could change all the time as you are changing your revenue, unless you revenue increase always in proportionally with the way expense increase. But otherwise, this ratio could change, right? So the net income has also its limitations because the net income is accrual basis. The net income does not necessarily always equal to the cash amount that you have at end of the accounting period, right? Because it's accrual basis, right? A lot of time you made a revenue, you didn't necessarily receive cash, or you incurred expense, you don't necessarily pay your expense. So the net income does not always equal to your cash. And also, net income does not really count for the change of values. It's just the how much revenue you're making, and then how much cost of the business in relates to those revenue that you are making, and that's the difference. So that value, the change of the value in your company does not include it in the income statements. A very good example, if you have an increase in your company's reputation, right? That's not going to count it as part of your net income. So net income does not equal change of the value. And net income sometimes also is not always exact because you have estimation involved too. So we will talk about this part later in chapter 4 when we have adjusting interest. So in the slides, there are a lot of examples. They have 5 6 different examples, just like the way we went through for these transactions. You can go through these examples yourself before you do your homework or before you do your quiz. So let me know. You can always email me or text me if you have any questions.